You know that if you're doing a backdoor Roth IRA strategy, that it's problematic to have pre-tax dollars also in a traditional IRA. So here's the question. If you're doing a backdoor Roth, but then you leave your employer, what do you do with your old 401k? I've got those 5 options. That and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Are you considering, or maybe are you implementing the backdoor Roth IRA strategy? Can be a fantastic strategy when the circumstances are right, but one of the situations where it means the circumstance is not right is if you already have pre-tax dollars in an IRA. This is for backdoor Roth IRAs, or really for Roth conversions. This is one of the unique times where the IRS views all IRAs as one, okay? Whether you have an IRA over at one company and then another IRA over there and another IRA over there, they look and say, well, across all of your IRAs, what's the ratio of after-tax money and pre-tax money? Therefore, you know, with the backdoor Roth strategy, it's a 2-step. You put after-tax money into your IRA, and then you convert that after-tax money over to your Roth IRA. If you don't have any pre-tax money in any other IRAs, the only thing you have is the after-tax money you just put in, no problem. That second step, that Roth conversion, not a taxable event, and it's a backdoor way of getting money into your Roth IRA. But if you already do have pre-tax money in an IRA elsewhere, then when you do that step 2, that Roth conversion, a proportion of it is going to be pre-tax money moving to your Roth and going to be taxable. If that's what you intend, fantastic. But if that's not your intention, it can create some significant tax surprises as well as some penalties and a lot of strife. So, real life planning scenario, meeting with a couple. They've got great income, make together about $300,000. And because of that, they're over the income, the threshold, the phase out where they're able to contribute directly to a Roth IRA, okay? Take a look here. These are the income thresholds. If your modified adjusted gross income is above these thresholds, then you're limited or potentially completely phased out of contributing directly to a Roth IRA. For him, he's already switched jobs a few times, so has a very large IRA that is already in existence. So they're not funding a backdoor Roth for him, but they are for her. All of her retirement dollars are with her employer, and so she has no pre-tax money inside of a traditional IRA, and we've been doing backdoor Roth IRA contributions for her for several years. Well, here's the issue. They just sprung this on me. She's leaving that employer. She's no longer going to be working at that same company. She's getting a different job, and honestly, as a sort of bad breakup, she's ready to part ways with that company, start a new chapter with a newer organization. So what do we do? What do you do with this old 401k now at an old employer that she wants to separate ties with completely? What are our options? Well, there's several. There's 5 that I want to go through, okay? There's 5, and depending on your situation, any one of these might make the most sense, or there could be a handful where you say, maybe this, maybe that. What about this one? You're going to want to work with your CFP to see which of these applies best. Now, in going over this with her, I'm just going to tell you, she didn't like the first 2. I don't really like the first 2 either, and so we threw those out. But the first one is, you could just leave the old 401k at the old company, and that would mean that you still don't have any pre-tax money in IRAs, and you continue to do backdoor Roths as usual. I actually like this strategy a lot when the circumstances are right. In her situation, she did not like this idea. She wanted to separate completely from that old employer. Plus, leaving a 401k behind at a previous company can create a lot of potential damages or dangers and threats where you lose track of the dollars, they lose track of you, the investment strategies get outdated, the beneficiaries get outdated. She didn't want anything to do with that. So number 1 option of just leaving the 401k, the old 401k there, and continue to do backdoor Roths, that one was off the table. Option number 2, I don't love either. We do it for some folks, again, when the circumstance is right, and that is you move and you roll over the old 401k into an IRA. So now you've got pre-tax money in your IRA, and you continue to fund after-tax money into your IRA. You just don't convert it. Because if you were to convert it, then again, it's the pro rata rule, and you can't just pull out the after-tax money from that IRA and move that to the Roth. It would be pro rata. So the alternative is, well, I'm at least I'd like to invest dollars somewhere. Let me invest them into this tax shelter, this IRA. Even though I'm not getting a deduction for it, at least the growth and the dividends and capital gains and interest on those contributions will be tax sheltered. If you're going to do this, make sure that you track your after-tax basis on tax form called 8606. It's vital that you do this because it could create some future planning opportunities. You want to be aware of your basis so that you don't end up paying tax on the money that you never got a deduction from in the first place. So those are the first two ideas of what to do with the leftover old 401k if you're trying to still implement a backdoor Roth strategy. Third, and this is the strategy that the individual ended up going with, and that is to transfer the old 401k into the new 401k. What do we like about that? Number one, she liked that, well, the dollars weren't going to stay at that old organization. She liked that there was going to be a clean break, a clean separation. Two, I mentioned that sometimes with dollars at an old 401k, you can lose track of them. They could lose track of you. You could lose track of beneficiaries. She didn't have to worry about all that because the new money would be inside, the old money would be inside the new 401k. And then finally, the other thing to like about this strategy is it continues to allow you to do the backdoor Roth strategy without really any hiccups or any extra tax. This third option, that's the one she decided to go with. But there are two more strategies we considered. The fourth one is to roll the old 401k into an IRA and begin doing Roth conversions of those pre-tax dollars into her Roth, but doing so over a 3 to 4 year time period so that the tax hit wasn't all in 1 year and moving them into the next tax bracket. I like this idea because we were able to stretch, or planning to stretch those Roth conversions over the next few years, keeping them in the same tax bracket. So it made a lot of sense. It also aligned more of their wealth to be positioned in the Roth, so it would grow tax-free for the future. And we could continue to do that backdoor Roth strategy. It just created a little bit of tax along the way. The reason why they chose not to go with this strategy, figuring out tax withholdings. I've talked about that a lot here on the channel. Make sure if you're not familiar with some of those options for withholding taxes and sort of my strong convictions on what you should do instead, make sure you check out that content. And then the fifth option that we opted not to go with either, and that is to move or roll the old 401k into an IRA, but instead of continuing to try to do backdoor Roths or funding after tax into the IRA, shifting to fund those extra dollars into a mega backdoor Roth IRA strategy. I loved this option. They said not the right time, maybe something to consider out there in the future. The mega backdoor Roth IRA is one where instead of contributing after tax to your IRA and then converting it to the Roth, you're contributing after tax to your 401k. But this is above and beyond your normal pre-tax or Roth limits. Above and beyond that, you contribute after-tax dollars up to the 415 limit, which is $70,000 plus catch-up contributions. You got to be mindful of company match and so on. So a lot of moving pieces there, but you can contribute a lot more after-tax to your 401k if it allows. But then you can then do a in-plan Roth conversion where you shift those after-tax dollars over to the Roth side of your 401k because they're after tax, it's not taxable to you. That's the mega backdoor Roth strategy. So if you're working the backdoor Roth IRA strategy and you shift employers, those are your 5 options. Work with your CFP to see which ones of those you can immediately rule out and which ones of those you should consider to come up with the right plan for you. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.